Hey everybody, it's Pete. Good morning. Welcome to a new episode of today's Best Stock Picks. It's Thursday morning, March 25th, 2021. Thank you so much for being with me here today. Got a lot to talk about today. We're actually going to teach a lesson today on risk and position sizing, which is a monster part of trading success. We're going to get into that. We're actually going to go to a fancy PowerPoint today. We're going to talk about does Roku, who re-announced again their intent to create their own branded content. Does the stock right now, which is sitting on the precipice of a big support level, have the chance to fall $70 over the next month or so? We're going to point out the chart. We're going to point out the level. We're going to point out the key prices that you need to know. We're also going to mention Tesla. We're going to take a look at the charts in Tesla. It's very common for me to get private messages and questions about Tesla. It's a very, very popular stock. Not looking great right now, I have to be honest with you. It's actually trading a little bit higher pre-market right now. And this is really where the clarity of just trading what you see on the tape versus what you hope to see on the tape. This is not last year's market. We talked about it in the boot camp that this is not the 2020 pandemic fueled in stimulus package rally that we had last year. It is different. We're seeing heavier volume on the downside. We are seeing lighter volume on the upside. And breakouts are failing left and right now, which is why we're going to do that segment on position sizing today. So stick around. We got a lot to talk about today. And if you find this stuff helpful, definitely let me know. Click down, give us a thumbs up, and subscribe. That would let me know that this is the kind of stuff that you really enjoy listening to. But to start out, I just want to look, I'm not an advisor. Everything we talk about here is for educational purposes. You make your own decisions. However, I'm going to talk to you as a friend, and hopefully you'll take this as a friend. Sometimes the market conditions are awesome, and when you buy, opportunities just fly off your fingertips, and you're just having great conversations about where you're booking your profit, and that's an awesome situation to be in. That was 2020. We're not there anymore. Right now, you need to be building positions as they move in your favor. If you're trading size right now, you're probably very frustrated. And again, we've been talking about it in the boot camp for about a month and a half now, that position sizing needs to be really, really disciplined, really, really focused and in sync with what you see in multiple timeframes, what you see in order flow. And only during those situations where everything is lining up, only then should you trade a little bit bigger position size. And I'm going to show you in that PowerPoint in a second exactly what that means. We're going to teach a little bit of a lesson. So we're going to get right into it. We're going to talk about data that's coming out at 8:30 today. We're going to talk about sector rotation and why we're starting to see a little bit of frustration. I want to get into that a little bit as well. What's confusing, for lack of a better way of putting it right now, is that the indices have been slowly, kind of like drifting, not necessarily collapsing, while hardly any stocks are breaking out and following through. We're getting some swing trade opportunities. We're still taking the ideas that we like, but we've lowered our position sizing. And that's really what's confusing some traders, is that the market is not going down the way you're starting to see some of these Teslas and Rokus and some of these bigger stocks, even the financial stocks, which are on fire, pulled back a little bit. And we're starting to see energy stocks, which were really solid bullish uptrends from November of 2020 right up until about 2 or 3 weeks ago, where they were leading the pack, went to the bottom of the list. And yesterday they were one of the sectors and industry groups we're going to take a look at right now. So let's head on right over into the chart so we can get right into everything that we want to take a look at. If you have any comments, I encourage you to leave a comment below, to ask me a question about stuff that we're talking about here in the videos, because that kind of back and forth is really the way that you can learn by asking questions. And I know what kind of stuff that you want to learn. So that's the best way to do it. So anything about what we talk about in the videos, absolutely ask me a question. All right. So obviously we have the jobs data coming out today, 8:30 initial claims, obviously looking to see, is it getting worse? Is it getting better? This is going to affect the futures markets. Right now, the futures, again, are kind of just drifting right around zero. You would not have guessed that at the way the market actually closed yesterday. We'll just pull it up really quick with the SPY right near the low of the day, if not the low of the day, and very close to breaking down. Again, I just want to keep pointing this out, that the heavier days in volume are where we're actually trading lower. So you can see a really light day and a day higher, 2 heavier days and 2 days lower. These are the clues. If you really want to be on top of your game and have conviction as a trader, these are the clues you need to pay attention to. It doesn't mean to bail out of your positions. It does mean you need to manage them a little differently. There's nothing wrong if a trade starts moving against you to scale back a little bit, but you need to respect risk if it doesn't stop going down, and very similar to what we're talking about in Tesla. So you need to be cognizant. You need to be aware that you're a risk manager in search of ideas that follow through. So if a whole bunch of ideas, you get small profits, small losses, and then a few of them follow through, that's the math for making money over the month and having consistency. Don't forget that. It's not every trade needs to be right. I'm going to actually show you, when we talk about position sizing, we're going to talk about that. So as far as sector rotation is concerned, this is really a big thing. This is the reason we're not getting follow through. You can see again, energy and industrials bounced yesterday, barely, basic materials as well. So we're going to focus on some energy stocks today. Charts don't look perfect. Like, let's be honest about it right now. We're not flying through to new highs. Again, a couple stocks. We took a long in UNH yesterday and McDonald's. AMAT had a giant gap yesterday. We did a short video on that in the middle of the day. That didn't follow through either. So this is why. Despite the fact that the indices longer-term bull market is still in place, this is what we're kind of seeing under the hood. So this is kind of like your car is still going forward, but the engine stalled. That's exactly what's going on right now until we see the engine start to rev up again, and these industries and sectors specifically start to turn green, at least for the day, never mind for the week or the month. Your car is just kind of skidding right now. We don't have any juice, and that's why the breakouts are failing, and we're seeing a little bit of a frustrating experience right now. So getting into Roku, this is actually news that was announced in January 4th, I believe, and now the story is actually coming full circle right now, where the branded content is becoming a part of the studio. They're starting to hire people right now. The stock actually took a hit, and we're going to take a look at the chart right now prior to that, and really the level. So what we're looking at right now, you can see here in January, this is when it was announced. We had one more move to the upside, but now the stock is like sitting right on the precipice of this 318 level. And the reason we have this on the bottom here, and this is an important lesson, is you need to understand where the smart money, where the deep pockets started doing something or started unloading. And right now we're talking about, you can see the volume spikes down here in this area. We're talking around 240. So we're literally talking about a $70 to $80 gap between where the price closed yesterday and where the smart money started to accumulate their position. And that happened over a couple of months, but that is the line in the sand that matters. That is the level right now. Where we are right now, do they come in and defend that level? If you're long, you need to be aware of this 318, 315 level, because there is a Grand Canyon below that. So what would we need to see to start buying again? Well, now we need to see the weekly chart in Roku doing this. We need to see well bid. That's what we need to see over a 10-day period. Remember, these weekly candlesticks are 5 days. We need to see it go higher highs, higher lows, and close on the highs. So until we see that happen, this is where we need to respect risk. All right. We're actually going to get into the PowerPoint first. I want to talk about methods of allocating risk, because this is a huge part of what we're going to talk about today. If you find this kind of stuff fascinating and you want to learn more about swing trading, we have a swing trade tracker program. It's an alert service. If you want, you get this entire course for free when you sign up. It's only $49 to sign up. Again, I'm not telling you to sign up. I'm just mentioning it if you want some extra help understanding this kind of stuff. This is a complete A to Z of order flow, tape reading, and what you're going to see here. We have a whole section on risk reward, sectors, and profit targets. So this is really where the rubber meets the road, where somebody who is good separates themselves and becomes great. Understanding when to preserve capital in pursuit of profits. All right. So first professionals never bet at all. They allocate percentages of their risk capital so that one position never wipes out their account. I know that sounds crazy, but you would be shocked to hear what some people do. All right. So for example, if you have $50,000 of risk capital, you decide to use $30,000 of it to trade stocks. You leave the other $20,000 set aside. You further decide that you're going to allocate $10,000 per trade. Let me actually come off the screen. This will be easier for you to read. You want to allocate $10,000 per trade. So that's a pretty simple breakdown, right? Then what you decide from there is, this means you can have 3 open positions at any one time. So if you want, you can screenshot that. Pretty easy, right? For the sake of simplicity, we're not using leverage, so we're just going to talk about allocating to this particular trade. So further break that down by the risk allocated per position by the risk they're willing to accept per position. I know that's a mouthful, but we're going to break that down for you right now. A common practice is to choose a percentage of the risk capital per position. So we just broke it down. Per position means 10%. So a percentage of that $10,000 is what you'd risk per position. And this might sound like a mouthful, but this is what it takes to be successful. So I just want to be clear about that. An experienced trader may choose to risk 2% of the allocated $10,000. That means you're risking $200 per position. So $10,000 times 2% is $200. Now, some of you might be saying, oh my gosh, how in the world am I going to make money only risking $200 per position? You're in this for the long run. You're allocating money smartly. That's how you last in the long run. I can't stress this strongly enough. By the way, if you want to learn more about this entire program, just click down in the description. You'll see the link. So anyway, next, risking per trade insights. Experienced traders who have a track record may choose to risk 5%. New traders without any trading experience may choose to risk less than 1%, so they could learn without the experience of the negative baggage of big losses. So again, risk percentage per trade is different based on the quality of the idea and based on your experience level. Many other factors go into the risk equation, such as the quality of the idea, but there's one main point to remember, and this is the part that you want to screenshot. You must accept the risk, the dollar amount before the trade, so that should the trade be unprofitable, you will exit immediately, which keeps your risk reward in sync with your goals. So position sizing methods, okay, how to give your trades the best chance to make money and how to keep your sanity. All right, so how the stop loss and the entry affect your share size. Once you've planned your risk per trade, you then make a final decision, which is how many shares per trade. This is also known as position sizing. And you're going to use the difference between the dollar amount you're willing to risk and your stop loss. Okay, so the formula is the dollar you're willing to risk divided by your stop loss, which is the entry price minus your stop loss, and that's the position sizing. So again, there's the formula. So if your entry is $60 and your stop loss is $58, so the difference between the two is $2, and you know you're risking $200, which is $10,000 times 2%. So then your share size is 200 divided by 2, which equals 100 shares. And out of that, you already know that you're going to use no more than $10,000. In this particular instance, you're using $6,000 of the $10,000 on that position. So it's pretty interesting to look at that kind of stuff, and you really need to map it out beforehand. So if this kind of stuff really fascinates you and you really want to learn how I do it, again, something that's interesting is that if you become a member, it's only $49 for the first 30 days. And if you decide not to stick around, no harm, no foul. But for a limited time, you can keep that course lifetime access. That's not available. It's available right now, but for a limited time. So if you want to do it, and you want to learn and get the whole course, just click down below and you'll learn about that. Some of the opportunities we're looking at, as we said before, we're looking at energy stocks. CPE actually had a nice bullish gap yesterday. You can see it's kind of opening neutral right now. Again, we don't have perfect ideas, but we are starting to see some well-bid candlesticks. Now, this is really what we're fighting. You're taking some ideas that are not absolutely perfect, and you're going to reduce, exactly as we just talked about, that position sizing. MTDR is another one. Again, these did not have a perfect chart, but they have been the strongest industry group and the strongest sector you can see here since November of last year. Yesterday might have been the first sign of these stocks waking back up. FANG, okay, again, not a bullish gap, but a higher opening and closed strong. You can see it closed around 3% higher. And COP, again, bullish gap, closed above the open, stayed there, up almost 3% again yesterday. So again, we're kind of searching for what was strong yesterday as something to lean on today. And that's really what we're going to be looking at. And that'll be, as we just showed you, a little bit lower position sizing. Next week, we're moving over to the industrials. Ingersoll Rand actually had a little bit increase in volume, closed well bid, closed well above the open, closed near the highs, and trading up around 48 and change. UNP, again, not a perfect chart, but on a day that the market got hit, this had really good relative strength. You could see it had a big green candle, which means that attention was on that stock during the day. Honeywell, excuse me, again, you can see on the bottom, increased volume from the day before, closed well bid, closed near the highs. Again, closed near the highs relative for yesterday's type of price action. And 3M. 3M is one that's been getting called out in our community for the last week or so. And again, had a really good, solid day yesterday. It looks like it's set to open up flat today. So, look, the bottom line is I just can't express this strongly enough. Maybe we'll meet, maybe we won't meet. So I'm going to give you just, public service wisdom, for lack of a better way of putting it. The market is less than perfect right now. Manage your position sizing perfectly. Manage it in sync with the quality of the ideas. Manage it in sync with how much capital you want to risk per trade. This way, if the market doesn't follow through, it's a lower risk profile so that you're not digging yourself a hole. So when the market picks up and we start to see some easier trades, or even just an industry group that's obvious, you're not digging yourself out of that hole, and you can actually have a better chance of being net profitable in that same time period. So these are things that professionals think about every minute. Professionals do one thing first: look to manage risk first, and then you look to see if there's justifiable profit in the context of that risk. And only then do you put the trade on. Amateurs, people who struggle, first look for entry prices and then just hope those entry prices hold. You need to build that argument. You need to look at the order flow. You need to look at the tape and then set up that idea. So hopefully this gives you some ideas of how to manage yourself right now if you're finding the market a little challenging, which everybody is, quite honestly. So keep the faith. Manage your risk properly. Be smart. Respect risk. And you'll come out the other side fine, as long as you manage the downside now when it's a little bit tougher. Okay? I'll see everybody soon. Have a great day. And thank you so much for joining me today.